The recent spike in volatility in equity markets reveals the risks of complacency when investors get ahead of the data. While the scale and economic impact of the COVID-19 outbreak remain highly uncertain, investors had prematurely priced in a V-shaped recovery as equity markets made new highs in February. With full valuations colliding with news of a rapid rise in new cases outside China, in places such as South Korea and Italy, it was not surprising that we encountered a bout of sharp volatility late last month. Given the wider spread of the outbreak outside of China, the odds of a V-shaped recovery in the global economy are now lowered, in our view. As a result, we have reduced risk in our asset allocation strategy by downgrading our position in Europe equities to neutral. This takes our overall equities position also to neutral. The spotlight now is on the policy response by central banks and governments. In the US, market expectations of Fed action have risen sharply. Fed funds futures are currently pricing in at least one rate cut by June and at least two by December this year. Singapore and Hong Kong have both announced large fiscal deficits to fund relief efforts, including cash handouts. Besides the progress of COVID-19, the other key variable that will drive markets from here is US trade policy uncertainty. We believe that the trajectory for trade tensions looks more benign this year, given the additional risks to the US economy from the virus outbreak, as President Trump is likely to be cautious not to derail the economy in an election year. For more information, please read the latest edition of our monthly investment guide titled Boosting Portfolio Immunity.